to Iron Financial. Today, we are running a complete no-nonsense structural stress test on a company that just delivered a truly jarring contradiction to the market. In this explainer, we're putting Duolingo under the microscope, and we're going to deconstruct their Q1 2026 results from the ground up. Look, this company crushed earnings. I mean, they completely blew past Wall Street's estimates, and yet the stock tanked. It literally fell straight through the floorboards. I'm your lead analyst, and my focus is entirely on the raw materials here: the revenue, the debt, the margins, and the fundamental structural integrity of this business. And I'm the market skeptic. I'm here to represent you, the retail investor, and ask the exact questions you're probably screaming at your screens right now. Because let's face it, Wall Street has absolutely no patience right now. In our current macroeconomic environment, any hint of weakness, any tiny flaw in the concrete is severely punished. So what we need to figure out is this: is this a permanent crack in the foundation, or is the market just completely overreacting to short-term noise? Because right now, the drop is glaring, and we really need to cut through the hype and find out what is actually real. Let's dive right into this. Okay, let's look at the reality of the market right now. The top line looks like a massive win. According to the Bazinga data, Duolingo reported Q1 earnings of 89 cents per share. That easily beat the street consensus estimate of 79 cents, a solid beat. And the revenue came in at about $292 million, beating the $288 million estimate. But the market doesn't care about the past, right? It trades entirely on the future. And the future management just painted looks like a downgrade. They narrowed their fiscal 2026 revenue outlook to $1.205 billion. That slightly missed the analyst estimate of $1.209 billion. Now sure, that is a mere $4 million miss on a billion-dollar run rate, but when a stock is priced to perfection, trading at a massive premium multiple, any slight downward revision triggers an automatic institutional dump. Lead analyst, you can tout that 89 cents all you want, but the market sold this off hard on disappointing guidance.
You're absolutely right to point out that algorithmic reaction, and price to perfection, is the operative phrase here. Wall Street demands flawlessness. But we need to look under the hood. We need to see if that massive sell-off is actually justified by the financial math, or if it's just an illusion.
So, here is the blueprint for today's explainer. First up, we'll look at a solid foundation. Second, we'll search for cracks in the armor. Third, we'll examine the heavy lifting of their AI pivot. And finally, we'll deliver the iron verdict. Section 1. A solid foundation.
Before we start panicking about the forward guidance, we have to acknowledge that the base they poured in Q1 is incredibly strong. Think about it. You simply cannot build a durable, long-term business without a bulletproof balance sheet and real, tangible user traction. When you look at the official Q1 blueprint directly from their shareholder letter, you see across-the-board strength. When I'm searching for structural integrity in a company, I look for this exact pattern. You don't want just one isolated metric holding up the entire building, you want a unified lift. And they engineered a massive quarter where every single major category, daily active users, paid subscribers, revenue, total bookings, and free cash flow, all moved up simultaneously. This isn't some vaporware tech company bleeding cash to artificially buy users. This is a highly profitable, self-sustaining growth engine that is actually producing real structural value.
And honestly, the sheer scale of their audience acquisition is staggering. Daily active users skyrocketed 21% year over year, climbing from 46.6 million to 56.5 million. But what's absolutely crucial here is the underlying metric, the day-u to MAU retention ratio. This ratio is the ultimate measure of app stickiness. It tells us how many casual monthly users are becoming hardwired into a daily recurring habit. That ratio is actively rising, supported heavily by faster expansion in Asian markets. Furthermore, the paid subscriber base grew in perfect lockstep, also a 21% increase, jumping from 10.3 million up to 12.5 million. Okay, 21% growth is solid, I'll definitely give you that. But remember, the Motley Fool transcript noted that only about 12% of their monthly active users are actual paying subscribers. Think about what that actually means for a second. That means 88% of the people using this app are essentially writing for free. They are taking up expensive server space without contributing a single dime to the bottom line. Is that really a strong foundation? Or is it just a massive long-term monetization failure waiting to happen? I totally get that concern, but I view it as an enormous untapped runway. If you have that much top-of-funnel volume, that many millions of free users just interacting with the product, even fractional tiny percentage point improvements in the conversion rate will yield massive downstream revenue. And they can achieve that without requiring any additional customer acquisition cost. The users are already in the building. And you know what? That downstream revenue is already showing up incredibly clearly on the balance sheet. Revenue hit exactly $291.9 million. Let's just call it $292 million, which represents 27% year-over-year growth. But the true measure of their operational concrete, the real heavy-duty stuff, is the adjusted EBITDA, which came in at a whopping $83.4 million. For those following along at home, adjusted EBITDA is the truest measure of a core engine's cash-generating power because it strips out all those non-cash accounting expenses and tax nuances. That is a 28.6% margin for the quarter. To put that into perspective, management's full-year target for adjusted EBITDA margin is roughly 25.7%. So they are currently operating at a margin profile that significantly exceeds their own baseline targets. Throw in a clean net income of $43.5 million, and it's absolutely clear. The core business is fundamentally printing cash. Now, the most crucial point of resilience is this massive number right here, $1,141,296,000. That is the exact amount of cash and cash equivalents sitting on Duolingo's balance sheet at the end of the first quarter. In a macroeconomic environment where the high cost of capital has squeezed tech companies dry and forced massive, painful layoffs across the sector, operating with zero debt is an absolute anomaly. It is a financial fortress. They have zero debt and they expect to generate over $350 million in free cash flow this year alone. From a pure structural standpoint, this company is literally encased in reinforced steel. Whoa, hold on, let me stop you right there. Because if everything you're saying is true, if the balance sheet is encased in reinforced steel and they are printing all this cash and they have absolutely zero debt, then why on earth did the market dump the stock so violently? Institutional trading algorithms don't just casually throw away perfectly good, zero-debt structural assets for no reason. Wall Street isn't dumb. If the foundation is so completely solid, there has to be a flaw in the concrete that you just aren't seeing. What exactly scared the smart money away? That is the perfect question. Let's move to Section 2, Cracks in the Armor. Time to stress test the guidance. All right. This brings us to the exact metrics that spooked the algorithms. This right here is the crack. In Q1, Duolingo posted 14% year-over-year total bookings growth. But look at the guidance they issued for Q2, just 5.8%. That is a massive, sudden deceleration. And for those tracking the difference at home, remember that revenue looks backward. Revenue is cash already recognized over time. Bookings, however, look forward at cash committed by users today, even if it hasn't been recognized as revenue on the books yet. Bookings are the absolute purest leading indicator of future growth. You do not go from double-digit growth to mid-single digits without raising some serious alarm bells. The market looks at that 5.8% forward-looking number and sees a growth story hitting a brick wall. So, lead analyst, explain to me how a 5.8% bookings growth projection is anything other than a complete disaster. I'll explain it using the CFO's own words because context is literally everything here. Gillian Munson addressed this directly on the earnings call. This deceleration isn't a fundamental breakdown of the business, it's a structural anomaly. She stated, quote, "Our expected Q2 bookings growth of about 6% reflects a tough comp. The prior year quarter included the initial rollout of Energy, a price increase on our most popular subscription plan, and exceptional advertising performance." End quote. Now, for those unfamiliar with the mechanics of the app, Energy acts as a stamina bar. When you make mistakes and run out of energy, you either have to wait or you pay real money to refill it. When management rolled that aggressive monetization feature out globally alongside a baseline price hike last year, it created an artificial, massive, unrepeatable spike in cash flow. You simply cannot repeat that kind of manufactured spike year over year. You have to absorb the tough comp and look at the broader aggregate trend of the business. Well, I'm not entirely convinced it's just a tough comp. Look at the real headwinds we've identified from the earnings call transcript. Yes, we have decelerating bookings, but the transcript also literally states that top-of-funnel growth for monthly active users was described as about flat. That's a huge red flag. If your top-of-funnel stalls out, your future paid subscriber base eventually dries up. It's just simple math. Furthermore, management openly admitted they're seeing pretty big increases in AI cost internally. So let's review. We have flat top-funnel growth, we have slowing bookings, and we have rising operational expenses. That sounds exactly like a structural vulnerability to me. Let's address those costs directly. Section 3, Heavy Lifting, the AI Pivot. Those rising operational expenses you mentioned, they aren't a vulnerability at all. They are a necessary, highly calculated renovation. Duolingo is currently undergoing a massive structural change within its core product lines. They aren't just sitting on their hands watching top-of-funnel growth flatten out. They are actively forging a completely new way to teach languages. And that kind of heavy lifting requires serious capital expenditure right now. What we are looking at is the direct result of that AI investment. They've completely overhauled the app to make spoken conversation a core part of the learning experience. We're talking about newly rolled out features like spoken tokens, speaking adventures, and vastly expanded flashcards. They are also implementing much improved video calls and gamified avatar costumes to drive engagement. This isn't just cosmetic paint. They're completely replacing the load-bearing walls of the curriculum to ensure learners actually master conversational concepts before progressing. It's a fundamental upgrade. And this number right here proves the sheer efficiency of their AI heavy lifting. In the first quarter alone, Duolingo published 20,500 course units. CEO Luis von Ahn noted on the call that this output is more than 10 times what they were shipping per quarter just 2 years ago. 10 times. Generative AI has fundamentally accelerated their entire production pipeline. Because of this massive speed run, they now offer professional proficiency courses, scaling all the way up to the B2 level on the CFR scale for all 9 of their most learned languages. Now, B2 on the Common European Framework of Reference isn't a joke. That means professional, workplace-ready fluency. They aren't just teaching users how to order a cup of coffee on vacation anymore. They are minting bilingual professionals. The product is definitively stronger and better than it has ever been. That sounds great for the users, but again, at what cost to the investors? This brings us right back to the margins. While Q2 gross margin is expected to be a very healthy 71%, management is openly warning everyone that it will trend down to approximately 69% by the fourth quarter. Why? Because running sophisticated large language models for 56 million daily active users requires an immense, mind-boggling amount of server power and compute capacity. As users actually adopt these fancy new AI-powered features, like those speaking adventures you mentioned, the aggregate computing costs go through the roof. You're essentially sacrificing profit margins in the server room just to fuel product features. And as we know, Wall Street generally hates margin compression of any kind, no matter the excuse. Exactly. Wall Street hates it, but management is completely transparent about that dynamic. 2026 is officially defined by Duolingo as a strategic investment year. What does that mean? They are deliberately managing towards slightly lower short-term margins in order to build a much larger, more durable long-term business. This is the classic tech monopoly playbook. You sacrifice a few short-term margin points today to build an insurmountable product moat for tomorrow. They could easily restrict AI access and artificially pump those EBITDA margins up to appease Wall Street this quarter, but that would completely compromise the foundation of their stated 2028 goal of hitting 100 million daily active users. And keep in mind, even with this margin compression, they are still guiding for $310 million in adjusted EBITDA for the full year. This is a calculated strategic flex from a position of absolute strength, not a sign of fundamental weakness. All right, let's bring it all together. Section 4, the iron verdict. We've looked at the pristine balance sheet, we've interrogated the decelerating guidance, and we've thoroughly analyzed the massive structural pivot toward AI. Now, it's time to synthesize all this data into a clear, actionable blueprint for recovery. Step 1. Absorb the brutal Q2 comp. Yes, 5.8% bookings growth looks incredibly ugly on paper, but it's just a mathematical necessity based on last year's massive pricing changes. It's a blip. Step 2. Aggressively deploy these AI features to drive deep engagement and user retention. Step 3. And this is the absolutely critical one. Management explicitly stated they expect sequential bookings acceleration in the second half of the year. Once that Q2 anomaly is fully flushed out of the system, a sequential reacceleration proves that baseline demand is structurally intact. And finally, step 4, continue generating that massive $350 million plus in free cash flow. If they execute this sequence, the foundation holds firmly. And importantly, management is putting their money exactly where their mouth is. They aren't just sitting back and telling retail investors to be patient, they are stepping into the market and buying the dip themselves. So far, under their authorization, they have repurchased 514,000 shares for a total of $50.6 million. That represents about 1% of fully diluted shares outstanding. Now, why does this matter so much? Because typical tech stock-based compensation dilutes you, the retail investor, by endlessly expanding the total number of shares. By proactively deploying capital to buy back those shares, management is completely offsetting that net dilution from equity awards. Listen, when a company with $1.1 billion in cash responsibly neutralizes dilution while buying back stock during a market overreaction, that is a massive, flashing signal of structural confidence. To sum it all up, we look at the words of the architect himself, CEO Luis von Ahn. We're building a product that drives long-term engagement and loyalty. We believe that's what will make Duolingo a much larger and more durable business. The broader market is notoriously obsessed with the next 90 days. But here at Iron Financial, we look at the foundation, the 21% core user growth, the absolute zero debt, the 20,500 new AI-powered course units. The long-term durability of this company remains fundamentally unbroken. So we leave you with this final, provocative question. You've seen the raw materials, and you've seen our structural stress test. So is this Q2 guidance a dangerous crack in the armor that signals deeper systemic issues? Or is Wall Street's algorithmic panic actually a golden opportunity for you to step in and forge a much stronger portfolio at a massive discount? The numbers are all out on the table. You decide if you're buying the dip or staying on the sidelines. Thanks for joining us on this explainer, and we will see you next time on Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.